A trust opened in 1924 is still paying out today. 4 generations have lived off it. None of them have ever filed an estate tax return on it because legally it has never belonged to any of them. Not their father, not their grandfather, not the man who set it up. It belongs to itself. That's the whole trick, and it's been sitting in plain sight in the tax code for over 100 years. Here's where it started. In September 1916, Congress passed the Revenue Act of 1916. Buried inside a bill mostly concerned with funding a possible war was the first federal estate tax in American history. Top rate, 10%, and only on the portion of an estate above $5 million in today's dollars. It sounds small now. It wasn't small to the people it targeted. For the first time, dying rich came with a bill attached, payable to the government, due before your heirs got a cent. The wealthy families of 1916 did not sit still. Within a few years, estate attorneys in New York and Philadelphia had built a workaround using a tool that predates the United States itself, the irrevocable trust. Put assets into a trust, give up legal control, and at your death, the assets aren't part of your estate. No estate, no estate tax. It worked, for 1 generation. The problem showed up at the second transfer. A trust set up by a grandfather for his children would dissolve when the children died, and the assets would pass to the grandchildren, at which point they became part of the children's taxable estate. The IRS got its 10%, then it's cut again, every single time the money moved down a generation. The wealthy had closed one tax event and walked straight into the next. For about 60 years, that's where things stood. Then 2 separate legal changes collided, and the trust stopped being a 1-generation tool and became something closer to permanent. The first change is obscure enough that most lawyers outside of trusts and estates have never heard of it: the rule against perpetuities. It's a piece of Old English common law, older than the income tax, older than the country. It says a trust can't last forever. It has to end, usually within about 90 years, calculated from the lifetime of someone alive when the trust was created, plus 21 years. The rule exists to stop dead people from controlling property indefinitely. For 2 centuries, it capped how long a family could keep assets inside a single trust before the structure had to break apart and the assets had to be redistributed, taxed, and restarted. In 1983, South Dakota repealed it. Quietly, with almost no national attention. A state legislature voted to abolish a 600-year-old legal doctrine because a handful of trust companies asked them to. Delaware followed, then Alaska, then Nevada. Today, more than a dozen states allow what's called a perpetual trust, a trust with no required end date. It can run for 200 years. It can run forever. The second piece is the generation-skipping transfer tax, created in 1976 specifically to stop families from dodging the estate tax by skipping a generation, leaving money straight to grandchildren instead of children, avoiding 1 full round of tax. Congress closed that gap. But in closing it, lawmakers had to define an exemption amount, a dollar threshold below which a family could still transfer wealth across multiple generations without triggering the new tax. That exemption is the same dollar figure as the regular estate and gift tax exemption, and it has grown enormously. As of 2026, it sits at $15 million per individual, $30 million per married couple, and Congress made that level permanent last year under the One Big Beautiful Bill Act, with annual inflation adjustments built in going forward. Put those 2 pieces together and you get the modern dynasty trust. A couple funds a trust today with $30 million, using their full combined exemption. That single act uses up their lifetime exemption and pays 0 gift or estate tax on the transfer. The trust is set up in South Dakota or Nevada, where there's no rule forcing it to dissolve. The money is invested: stocks, real estate, private equity, whatever the trustee chooses. It grows. Here's the part that breaks most people's intuition. Every dollar of growth inside that trust, from this point forward, is also outside anyone's taxable estate. Forever. Not just the original $30 million, the appreciation on it, compounding for 100 years, 200 years, however long the trust runs. The grandchildren who eventually draw income from it never owned the principal. The great-grandchildren after them won't either. There's no event where the IRS gets to step in, because there's no death of an owner. The owner is the trust. The trust doesn't die. Compare that to a family with the same $30 million who simply leaves it to their kids the old way. At death, anything above the exemption gets taxed at a federal rate up to 40%. The kids inherit what's left, invest it, and when they die, the next round above their own exemption gets taxed again. Run that forward 3 or 4 generations, and a meaningful share of the original wealth has gone to the government in repeated installments, even before counting state-level estate or inheritance taxes that some states still apply at much lower thresholds. One family pays the toll at every bridge. The other family bought the bridge once, and now nobody else gets charged. This is not some gray area aggressive maneuver that an IRS auditor might unwind. It is a documented, codified structure. Families like the Rockefellers, the Mellons, and the DuPonts were using trust structures to hold concentrated wealth across generations going back to the early 20th century, long before the modern dynasty trust existed in its current form, the estate records that surfaced through probate filings after their deaths in the mid-1900s show extensive, deliberate trust planning. What changed since then is not the goal. It's that the legal tools available to achieve it got dramatically more powerful, starting with South Dakota's 1983 vote. Why doesn't everyone do this? 2 reasons, and neither is secrecy. The first is the exemption threshold. You need real wealth, tens of millions, not hundreds of thousands, to make the structure worth the legal cost of building it, which typically runs into the tens of thousands of dollars for setup alone, plus ongoing trustee fees. The second is that almost nobody outside of trust and estate law encounters this information by default. Financial advisors who sell investment products have no reason to walk a client through a structure that doesn't generate a commission for them. Most attorneys who handle wills for ordinary families have never drafted a perpetual trust because their clients never approach the exemption threshold where it matters. The information isn't classified. It's published in state statutes, IRS revenue rulings, and law review articles. It just has no obvious salesperson, so it stays inside a narrow professional world. Trust companies in Sioux Falls, estate attorneys in Wilmington, family offices that exist specifically to manage this kind of structure. There's a second layer worth knowing, separate from the tax mechanics: privacy. A will goes through probate, a public court process. Anyone can request the file and see who got what. A trust does not go through probate. The terms, the beneficiaries, the amounts, none of it becomes a public record. South Dakota in particular has built strong statutory privacy protections around trust documents, specifically to attract this business. For families managing significant wealth, keeping the size and structure of that wealth out of public records is treated as valuable in its own right, independent of the tax savings. None of this requires offshore accounts or anything resembling concealment from the IRS. Every dollar that moves into one of these trusts gets reported on a gift tax return. The exemption is tracked by the IRS down to the dollar. This is wealth transfer done entirely inside the rules Congress wrote, using a loophole that exists because closing it would require either reinstating a 600-year-old common law rule across a dozen states or rewriting the generation-skipping tax exemption from scratch. Neither has happened in over 40 years, and there's no serious legislative push to change it now. What you do with this information depends entirely on where you sit. If you're nowhere near the exemption threshold, the Dynasty Trust isn't built for you, and no amount of restructuring changes that. What is available to almost anyone, regardless of net worth, is the underlying principle. Assets held in the right legal structure can avoid repeated taxation at every generational transfer, where assets held directly cannot. Irrevocable trusts, even simple ones, still do meaningful work below the exemption threshold for state-level estate taxes, asset protection, and avoiding probate. If you're closer to that threshold than you think, and with the exemption at $15 million per person now, more families cross it through a business sale or appreciated real estate than expect to, this is worth a conversation with an estate planning attorney, not a financial advisor selling a product. The distinction matters. One gets paid the same whether the structure is simple or sophisticated. The other doesn't. South Dakota's legislature didn't know in 1983 that they were creating the most durable tax structure in modern American history when they voted to repeal a rule nobody had thought about in a generation. They just wanted the trust business. They got it. And somewhere in Sioux Falls right now, a trust company is managing money that won't be taxed again until the rule against perpetuities means something it hasn't meant in over 40 years.